Coming at you live from Colorado Springs, Colorado, and I'm joined by my good friend Mike Chepka. How's it going, Mike?
It's going good, Kurt. I apologize to everyone on the audience ahead of time. Occasionally you'll hear a slight sniffle or maybe a little cough, but I'll try to put myself on mute. Still fighting through that after effects of the cold there, but we'll manage through.
Yeah, you still a little under the weather there, are you, Mike?
Yeah, that's right. Just getting over it. So we'll be good, but just apologize ahead of time.
Okay, very good. Now, I'll try to do a lot of the talking, but there's a lot of this particular presentation you'll want to chime in on, I'm sure, since it involves one of your trades. So, folks, I'd like to mention that in order to get the most out of today's free webinar, I'm going to encourage you to participate in the polls. We're going to do a number of polls here, and they only take a minute or less. Essentially what will happen is something will come up on your screen, and then you'll be asked to choose one or more sometimes. Sometimes there's more than one answer that's appropriate. Just help Mike and I get to know you a little bit better. And sometimes we'll prompt you for a response as well. We are going to be able to answer questions, but it's easiest if, for example, you pose those questions by way of the tool there, the question tool. If you'll maybe wait until places where we're going to pause to have those questions answered, okay? And let me do just a warm-up poll right now. I'd like to know, what kinds of options trading that you're currently doing, okay? What kinds of options trading are you doing now? And if you're not trading options at all, let us know that too, okay? All right. So we'll put that out there, and we're getting very good response. 25% have already voted, 30% now. We're only 17 seconds in. Very good, folks. I sure appreciate the feedback, and it's going to help Mike and I to pace certain parts of this presentation so that we'll know, whether we need to speed up or if we need to just, go right to the chase on certain things. Okay, we've got over half the votes in, and it's 39 seconds in. I'm going to leave this up for just a few more seconds here, Mike, and then we'll take our results. Okay. So 3, 2, 1. All right, thanks, folks, for your input. And let me go ahead and share that. Mike, of course, first place is what we often see in first place, which is folks that are trading covered calls. And for those of us that are not doing options, just in a nutshell, really fast, what is a covered call?
Oh, well, we're going to buy stock, and we're going to sell a call against it. So we're obligated to deliver our shares of stock at a set price, but we're going to receive a premium to do that. So if we get assigned at that price, we might make average, Kurt, we think 2.5%, 3% is a reasonable possibility with the current volatility in the market, maybe a little bit less than 3%. But, of course, what we're looking at there with covered calls is, this is, we'll talk about that a little bit later. They say it's safer, but we don't really feel that necessarily, do we?
Right. That's I call it the gateway drug because that's how I got started. It's how you got started. It's how most folks that are doing options at all got started is by qualifying for covered calls, maybe going to a weekend seminar and or even getting some free information from a broker and trying that as an option. We've also got second place. We've got a lot of folks doing spread trades. That's marvelous. Today we're going to show a riskless spread trade. It's kind of interesting, and that's going to really well, it's going to turn some folks on, I think. We've got 43% doing long calls and puts, and 9% not trading options at all. And folks, if you're not trading options at all yet, I'm glad that you're here, because we're going to be presenting how to properly use options, because the way that it's presented in a lot of other forms is kind of dangerous, to be frank. It's kind of dangerous. We're going to be showing a much more conservative approach. So super. Okay, Mike, I'm going to give a real fast introduction on how RadioActive Trading got started and what it looked like. In 1998, I went to a covered call seminar called Zero to Zillions. And some folks in the room may even be familiar with that seminar, or the person that put it on. That fellow is currently serving some time in jail. But I I began to follow the directions, buying stocks and selling calls against the stock, and was doing pretty well for a while. But what they say is, everybody's a genius in a bear
bull market, right?
Right. Yeah. So one of these plays, I said, you know what, this is working out so well. This is awesome. And I used a platform for searching for the best cover call plays. I don't think it was Power Options, Mike. Although Power Options was around back then, maybe I should have had Power Options as my as my go-to resource. But what I did was I found this company that was trading really high premium cover calls. It was around $17 a share, and I sold. Get this, I sold $20 calls for next month out for $3. Now, nowadays, I was a newbie then. I thought, wow, what luck! This is cool. I'm going to make a lot of money. When I get called out, there's going to be a $3 profit on the stock, right?
Yes.
Because the stock will be trading at $20, of course, and I'm collecting $3 premium for selling this call. So that's going to be $23 in, selling the stock for $20 and get paid $3 to do it. I'm going to get $23 in on a $17 investment, and that's going to be about a 6-week gain of 30%. I thought, wow, this is great. And then my company opened at $9. Remember, on the previous slide, I had bought it at 17.
Right.
It opened at $9 and headed down from there. Now, Mike, you know that that big fat premium should have been a warning sign to me, but I just really didn't understand about risk. I hadn't been taught about risk. And what made this worse? Well, what made this worse. What was it?
Well, you also entered the trade on margin, because if you're looking at 30% return, let's make it 90% return or higher by using margin.
Right. And I was using a full-service broker at the time. He happened to be the father of 3 of my black belts. I own a martial arts studio, and still do. And 3 of his young men had become black belts in my school, and they had trained for over 6-7 years. And so we had a relationship. So Mike calls me, not you, Mike, but the other Mike, my broker, calls me and says, Kurt, they're asking for a margin call. What do you want me to do? I was completely cleaned out. And the thing is, it costs, a couple $3,000 to go to the seminar in the first place. It cost several thousand to do this stock timing software, plus $100 a month for the data feed. And I spent all my time, all my free time studying charts and fundamentals and trying to figure out, how to do this training game. And I ended up in the hole. Nobody had taught me how to keep out of trouble. And I thought to myself, okay, Frankenberg, what would you say to somebody that you were training for the cage? I teach people, you probably know this, Mike, I teach folks mixed martial arts, and so I've put a number of folks in the ring for kickboxing. I've put them in the cage for cage fighting. And when they come out, if they come out a winner, we still go over the tape. We still look at it and say, okay, now what are we going to remember to keep doing? But if we come out with a loss, what do? We say, oh, that's tough luck. You just, hard luck, man. Or do we just actually examine the behavior? What we actually will do is say, okay, you guys are evenly matched. You both have the same weight, same experience level. Why'd you lose? What happened? And it's almost always a behavioral thing. It's almost always a behavioral. So I decided, geez, what behaviors caused me to get into trouble? And why don't I just reverse them? Instead of selling a call to hedge my stock, why don't I buy a put? That was the thought that went through my mind. Another thing, too, Mike, is that, when you sell calls, you want to sell front-month calls, right?
Yes, we get the better annualized return selling month by month by month, because the call that's 6 months out in time is not 6 times the cost of the current option.
Right. You might be able to sell a covered call that's out a month, a month out for 50 cents, but you might be able to sell a covered call that's out 4 months for $1.
Mm-hmm.
Well, that's twice the premium, but it's 4 times the length of time, so you're not getting as much, right? So the month-by-month approach works better when you're selling. But if we're going to buy, I thought, you know what? This makes sense. When I buy an insurance policy, it costs me more when I pay monthly, but when I pay a year at a time, they give me a discount.
Right.
And I found that the same thing happened in the in put options. Okay, when you buy a put option to insure your stock, you get a better per month price when you buy that put far away in time. And instead of selling a call that was slightly out of the money, I thought, okay, since we're reversing everything, let's buy a call that's, buy a put that's in the money, and let's not borrow anything. That was really the big kicker, you know, was to learn that, look, Frankenberg, if you're going to trade, don't borrow money to trade. And that's what the margin thing was all about. So I stopped using margin, at least at the beginning. You know, later on, after you bulletproof a position, you can use margin.
And there's some brokers out there there's some brokers out there now for specific investors. They will offer the portfolio margin, which could be used in the case of a married put or a collar. But yeah, in general, you want to wait till you're bulletproof until you may be able to do some of that. We talk about that in the blueprint as well.
That's right. Well, this is what that turned into. It turned into trading with the net. You know, Mike, when I was in my 20s, my oldest daughter, she's now married and has kids of her own. But my oldest daughter, when she was 3 years old, I bought her a trampoline.
Mm-hmm.
Okay? I know, responsible parenting, but I got hit in the head a lot as a martial artist. So, so I bought her a trampoline for her 3rd birthday, and then she and I were jumping on it, and I could do somersaults and front flips and stuff like that. And she said, "Daddy, do a backflip." And I started to, you know. In fact, I was like halfway through it before I realized, wait a minute, maybe this isn't as easy as they make it seem. And I started to panic, and I came undone.
Mm-hmm.
You know, the decision that seemed pretty good at the beginning, while I was in midair, it started to seem like maybe this was a bad decision. And I started to correct while I was in midair. Sounds like some of us with our trades, right? You know, it seemed like a good idea, but now the stock is going down. What do we do? And what happened was I came undone, and I ended up hitting the edge of the trampoline and then falling off of that onto my back on the ground. And that was a bad experience. But what a good experience was do you see this device here, Mike, with the poles going up and down?
Yeah. Mm-hmm.
And these are bungee cords, and the fellow right there in the middle has got this harness attached. So essentially, you know, I learned that I could jump up and down on this trampoline. I could jump up and do a triple backflip, no kidding, land, and then do an immediate double front flip afterwards, and have perfect form. And the whole reason for the perfect form was because, you know, in midair I wasn't going, holy cow, what am I going to do? I couldn't get hurt. It turned into trading with the net. When I decided to buy puts that were far out in time and in the money, it changed my life. Now, Mike, this is my first radioactive trade back in October 1, 2002. This is something that I did after doing a number of months of paper trading. I finally had saved up some money after my bankruptcy and divorce and all the other crap that I had to go through. I'd saved up enough money to get into 100 shares of Amazon at $16.09. Wish they could do that today. And this isn't a misprint. This is 2002, but the 2005 dollar put options were available.
Right.
Okay. And so I bought a $20 put over 24 months away in time. And the thing is, that was pretty expensive. Now, the total cost of the investment was $24.99, and I'm guaranteed by that put that it's going to be $20. Now, some of you folks that are not trading options yet, this is kind of like just having a face value on my insurance policy. Okay, here's my deductible, right, the $4.99, and here's what I'm guaranteed to get back. I'm guaranteed to get 20 back. Okay, so I spent $24.99. I'm guaranteed to get 20 back. So what's my risk?
Well, the total monetary risk is $4.99 per share, or 20%. Now, when we set up the radioactive trades today, we don't take that high of a risk. Our risk is usually around only 5, 6, or 7%. on the stock, still using maybe this time frame or maybe even a shorter time frame, at least 5-6 months out in time. But yeah, your risk here was 20%. Normally every position I open is around 6%, 5% at risk.
Right. The thing is, this is 20%, and that is way more than I would risk today. But let's keep in mind that I had just risked over 100%.
Right.
I mean, I was actually risking, with the margin thing, I was risking over 100%. So now I'm getting a little smarter, right?
Mm-hmm.
And of course, here now, what is it now, 11 years later or something ridiculous? More than 10 years later. Now I would keep my risk down to 5, 6, 7%, okay? But here's what happened. The far left there, Mike, is my entry point. The far right is where the stock was after about a year.
Right.
And remember, there's more than a year to go. We did okay. We did okay. Now, Mike, we already asked in poll 1 what type of option strategies folks are trading now. And what I'd like to do is I'd like to do a follow-on poll to that and ask, how are you doing with it? Okay, how are you doing with it? Are you happy with your 12-month performance? Okay, just a real quick question. Are you happy with your results so far? And then what we're going to do is we're going to show how that structure that I just showed can be used to make your stock bulletproof. And we're going to use some historical stuff. You know, I mean, gosh, we just showed a trade that was more than 10 years old. I'll show another trade that's a few years old, but we're going to show some current trades before we're done, right, Mike?
Yes, we're going to take a look at actually 3 positions that we're tracking in the Fusion portfolio right now. We might not look at all 3, but we're going to show some of the similar examples of the income method we're discussing today that can be used on at least 2 of those positions. Actually, it can be used on all 3, but we don't want to give away everything for free.
Yeah, that's right. Okay, so Mike, I've got some really good participation. And I am happy to see that the lion's share of our subscribers today are doing okay. They're making some money.
Okay.
But again, you know what I say before, everybody's a genius in a bull market.
Yep.
So, okay, let's go ahead and close and share the results. Okay, so we got 4% that are saying, man, yeah, absolutely kicking butt and taking names. You know, sign me up. You know what? I should be teaching this seminar.
Mm-hmm.
Okay, cool. And then we have 50% of our audience saying, I'm making money, but not enough. Now we get into the negatives. We've got 31% saying, I see potential, but I need to change my game. You know, mixed emotions. 4% saying, not only I lost, but ouch, I lost money last year. And then 12% that are ready to quit.
That's unfortunately the highest we've seen in a while.
Yeah, yeah. To 12%, I think that's high. You know, we've seen 4%, 8%, 6%.
Mm-hmm.
Today it's 12%. Okay, so folks, thanks for your candor. Thanks for your honesty. Thanks for telling us what's going on. And what we're going to do is we're going to use this as the baseline. I'm going to show you some things, and after showing you those things, I'm going to say, okay, now what? If you knew this a year ago, what would your answer have been? Okay, so very good. Mike, does it say poll 2?
It does, yeah.
Okay, good. So we got 4% said absolutely, 50% said and then the others said, well, not so much. So I'm going to tell you why we're having problems, okay? The reason why we're having problems is that when you have a loss, you'd think that there's a one-to-one relationship with your losses and your gains, but there isn't. For example, if you have a 10% loss, you don't need a 10% gain to get back to where you started. Mike, if I started with $100,000 and I had a 10% loss, what would I have left?
What would it be back? I'm sorry, did you say 10,000, Kurt, or 100,000? I'm sorry.
100. Yeah, if I had $100,000 and then a 10% loss, then what would I have?
We'd be down to $90,000, Kurt.
Okay, and so I take my $90,000 and then I play it and I get a 10% gain. Am I back to where I started?
No, because you reinvested your $90,000, and
right.
Excuse me, Kurt. You reinvested the $90,000. You make 10%. You made $9,000, so you're at $99,000. We're still short $1,000.
Right. So if I lose 10% and then make 10%, I'm not back to where I started. I'm $1,000 short. Not cool. It gets worse. Okay. A 20% loss would mean you need a 25% gain. A 25% loss would mean you need a 33% gain.
Mm-hmm.
A 33% loss means you need a 50% gain. And think about it. If you lost half your money, you'd have to take what you have left and double it, which is 100% gain. Double it just to be back where you started.
Mm-hmm.
Okay? So if a 50% loss means that you need a 100% win to get back to where you started, well, let's talk about this, okay? It's what we call an exponential curve, right?
Right.
And the results are not arithmetic, they're logarithmic. Logarithmic, meaning that the more we lose, the more rapidly it increases that we've got to gain just to get back to where we started. Remember, 33% loss, you need to take 50% of what you made and add it just to get back to where you started. 50% loss, you need to double it. So if we have a 50% loss and need to get a 100% gain to get back to where we started, well, what does a 5% loss mean?
Well, if we just divide it by 10, we'd probably need a 10% loss, 10% gain just to get back to break even, Kurt, but we know that's not the case, is it?
Right. This is the mathematical secret that everybody that's successful in their trading is applying, whether they realize it or not. A lot of times folks are winning and they think that it's due to, well, you know, I'm good at picking stocks, and that is a factor. They think that, well, I'm good at timing trades, and that's a factor too. But you know what? I've actually been wrong more often than right on my picks and my timing, and still made money. Been wrong more often than right and still made money. That's really something. So a 5% loss doesn't mean that you need to win 10% to get back to where you started. A 5% loss, when you actually do the math, is counteracted. It's offset by a 5.26% gain. Now, Mike, can you wrap your head around that? I mean, it's hard to expect a 100% gain, although it happens. It's hard to expect a 100% gain from a stock, but is it, you know, reasonable to expect a 5% gain, 5.26% gain?
Absolutely. I mean, I have some stocks today that are up close to that are up, 3 or 4%. I'm going to, while you're going on to talk, I'm going to do something real quick on the power options tools. I'm just going to run a basic search to see any stocks, just one strike out of the money in a basic strategy that have moved up 5% today.
Today, yeah, in a day. Yeah, absolutely. That's doable. So, if we were somehow able to limit our losses down to single-digit percents, okay, down to, say, 5%, but leave the upside open, well, what if we were to make dimes and lose nickels? You could actually be wrong more often than right and still make money. The problem of trading is that you just don't know what's going to happen next, and for that reason you're going to have losses, and strings of losses are inevitable, but also strings of wins. If we are able to keep our losses manageable and let our winners run, why then that's kind of the holy grail to trading, okay? Here's how we're going to solve the biggest problem, okay? We're going to solve the biggest problem, and I posed this question in the RadioActive Trading webinar. I don't know if I've got this poll loaded up, okay? I don't think I do today. But very often I'll say, hey, what is it that you need to fix? Okay, in your trading, if I could fix one thing, what would it be? If I could improve your trade timing by 10 or 15%, so you're right a little bit more often, would that be helpful? Or if I can improve your stock picks by 10 or 15%, so that when you win, you win a little bit more. Or could I build some time into your day? If I was able to help you quit your job or have more time in the day somehow to trade, would that be what you want? Or would it just be controlling losses? Would it be controlling losses? You know what? Most people say, geez, I don't mind losing, but if I could lose a lot less, that would be helpful. Okay? Rule number one is don't lose. And the reason that you have the capital to catch those runaway winners is that you haven't lost too much on the losers. What you laughing about there, Mike?
Sorry, I'm sorry, folks. Our attendee, Rob, chimed in. He says, fix my mother-in-law. So caught me off guard.
That's awesome. Well, Mike, we're going to discuss a trade in which you made 59.8%, right? But before that, the same year, you had another trade that the stock, you were long on the stock, and the stock lost over 50%. Now, if you had taken that loss, would the 59.8% win be enough to offset it? Let's think about it.
No.
If you had a 50% loss, and then you took what you had left and you got a 60% gain on that, would that be, would that be enough?
No, because we saw earlier I would have needed 100% gain on my next trade just to get back to break even. So I'd still be in the hole with a 60% win and a 50% loss. Right.
But in fact what happened is that you had a 4.5% loss. You had only a 4.5% loss because your stock was protected by a put option. And so, you're able to make 59.8 in one play, but you only lost 4.5% on another play.
Right.
And so that was a winning year. Okay. Mike, is the screen blank? Has something happened on my screen?
No, I said the reason that you'll have capital to catch those runaway winners is that you haven't lost too much on your losers, which is what we were just talking about. By controlling the losses, even if I'm long stock the whole time, we see a 50% loss, then, oh, okay.
Yeah, something's happened with my screen here. I'm not sure what the deal is. I'm on the phone with you, of course.
Kurt,
something's happened to my screen.
Ladies and gentlemen, I apologize. Kurt, real quick, it looks like it's showing me that you're currently offline. You're
okay.
logged on there, but it's via phone. But
I think you may know what has happened. So let me go ahead and fix it. And while that's going on, let's. I'm
going to do something here. Okay, what I'll do is I'm going to talk about this real quick in another instance, and what you hinted at. We're going to go over to. I'm going to take the screen from you in a second. We're going to go over to RadioActiveTrading.com real quick, and we're going to take a look at the trade simulator tool for a brief instant. Oh. Actually, no, you're back now, so we don't need to do that. But I have it up if we want to do that later. Sorry, folks.
I think we'll get to. So thanks for being a pro there, Mike, and being ready to catch the ball. I think I know what happens, and it says my network connection has been reestablished. So are you seeing a big fist there on the screen?
Yes, sir.
Oh, okay, happy day. Now, this is how we want to stay out of trouble. Okay, it's called force ideal sized trades. Okay, force ideal size trades, and that's the first principle of RadioActive Trading. And we're going to show how that works. Now, Mike, this again is not a current trade. We are going to show some current trades here in a few. But here we have shares of Humana at $63.90 and an August 2011 $65 put. Okay, I bought this in March of 2011. Okay, so my total invested amount here is $69.70. My guaranteed exit is 65, so the most that I could possibly lose is the difference, okay, $4.70.
Right.
Now that's about 0.5%, 6.7% of the underlying trade. Also, this is scalable. Instead of 100 shares in one contract, I could buy 200 shares in two contracts. Would that be more risk, or would it still be 6.7?
Well, it'd still be 6.7%. Your monetary risk would go up to 940 total, but it's still 6.7% of the capital that you invested into this single position.
Okay, so the first layer of protection when I'm getting into a radioactive trade is to use the put option that's far away in time and slightly in the money. Okay, and that's the first level of protection. The second level of protection is diversification. And, Mike, I did this in an account where I was trading with over $100,000 in capital. Now, if the dollar amount that I can lose is $940 and I have $100,000, what's my risk to the overall account?
Well, it's less than 1%, Kurt. It's 0.94% of your total portfolio value.
Okay, good. Now, it's important that you keep that in mind, folks. The reason that I'm mentioning that to everyone is that I want you to reconsider here in a few moments. Okay, we'll do another poll. I want you to reconsider what your year would have looked like if you kept your risk in your losing trades down to single-digit percents, right? And also that no one trade could damage your account by more than 1%. Okay, so So that's the deal. Okay, so if we're trading $100,000 with this play, that's 1% of our portfolio total.
Mm-hmm.
Okay. All right. So, folks, I'm going to ask you to finish this sentence. Okay. Cut your losers short, and what else? What's the next thing? Cut your losers short. And we've got 64 of you on the line. I know that one of you is going to be the first to answer this question. Cut your losers short.
CW and Joseph, they're chiming in. We want to let our winners run.
Oh, yeah, and then in came Michael and Paul and
Neil. Yeah.
Okay, and Rob. Okay, very good. All right, thanks, guys. Cut your losers short, let your winners run. Okay, now, does the strategy of selling covered calls or naked puts go well with the idea of cutting your losers short and let your winners run?
Unfortunately not. It's actually the opposite. Michael agrees with us. No, that's not what it does for us there.
It is. It's kind of the reverse. It cuts your winners short and lets your losers run.
Mm-hmm.
Okay. What about spreads and butterflies and condors? For example, let's say I've got a condor trade on.
Okay, four-legged spread.
Yeah. And not everybody's going to be familiar with that because I see that only about half of our audience is trading credit spreads. But listen, let's say I'm in a condor. Do I want my stock to go through the moon?
No, with a condor, it's a neutral trade. We need to have the stock stay in a limited time range. Mm-hmm.
So by definition, it can't allow winners to run.
Right.
There's a maximum amount that you could win, and then of course there's also it's possible for you to lose two ways. It's possible for you to lose if your stock goes up or if it goes down. So yeah, it doesn't allow winners to run. Okay, so call me crazy, Mike, but I got this idea that cutting your winners short and letting your losers run was not the way to go. If it was anything else, if it was, if I was getting into a real estate investment and I said to you, Mike, I've got this real estate idea, and if I'm right about it, I'm going to make 3 to 5%. And if I'm wrong, I could lose everything. Would you advise me to do that? Or if I had another play, if I had another thing, and it was like, geez, there's really no limit to what I can win, but if I lose, all I can lose is 5 or 6 or 7%. Which of those two would you ask me to consider?
Well, I'd want to consider door number 2, Kurt. I'd want to have the position where I know up front the most I could lose is 5, 6, 7%, but I still have the unlimited upside profit potential.
Right. Okay. So leaving ourselves in this kind of a position where we have unlimited upside potential but limited risk is the way to go. Now, we're going to show a little bit later on how to make this line. Are you seeing my cursor?
Yes, sir.
Make this line appear above the break-even line. Ooh, that would be awesome because then we'd be what we call bulletproof. Now, so far I haven't been proven wrong. With regard to this Mary put thing, we got a lot of thank you letters in 2008, okay? Because the average radioactive trader that was following the rules in the blueprint, they did lose. And when they lost about almost 4%, where their buddies that were in mutual funds were losing 40%.
Mm-hmm.
But then, of course, when you're at the bottom of the market in March of 2009 and you've got 96 of your marbles left, well, I've gotten a few thank you letters from that too. Maybe we'll put up RJ's letter a little later on. RJ that started trading radioactively in March of 2009 and ended up sextupling his money.
Mm-hmm.
Sounds kind of sexy. Sextuple means multiply it times 6. Well, anyway, so far we haven't done that. I'm going to ask you, in the last 12 months, if you had no loss over 6% of what was in the trade or 1% of what's in your portfolio, would just that have helped? And if the answer is yes, marvelous. But we've got more to show you. We're going to show that riskless spread trade that most of you signed on today for, and that is how to bulletproof your stock. Okay? So I'm going to ask you, again, if you used puts last year to protect your stocks that went down, and perhaps if you also had 11 different ways to pay for those puts, if you had a way to pay for those puts, would that make a change for the better? Okay. let's be real honest, okay, the answers go from no change, or I think I would have done worse, to, well, I might still have lost, but I would have lost $1,000 less than I did lose, right? Or, hey, I lost overall last year, but I would have won if I'd have done that. Or, I won last year, but you know what? My losses wouldn't have cut into my wins so badly. It would have been bigger wins. Or, hey, I would have been one of those that said I'm very happy with my trading. And who said that today, Mike? Was it like 4% or 6%?
4% were very, very happy with their trading, Kurt. Mm-hmm.
Right. 4% said I'm very happy with my trading. And let's see if there would be more than 4%. Okay? All right. So, poll's been up there for a full minute. I think everybody that's going to vote has voted. If you haven't voted, please do. And we'll give it 3, 2, 1 second, and close. All right, Mike, I gave everybody a chance. Let me share. Nobody said no change, or I think I would have done worse.
Mm-hmm.
6% said, you know what, I might still have lost overall for the year, but my losses would have been lessened by at least $1,000. So, did I just now save $1,000 for everybody's trading for the next year?
Pretty much looks like it, doesn't it, Kurt?
Yeah, and every year after that, right?
Mm-hmm.
Nobody said, hey, that wouldn't have made a difference, or I would have done worse. Everybody said either they'd be ahead by $1,000 or more. 33% said I lost overall last year, but would have won if I'd have done that. Okay. 39% said I won last year, but I would have it would have been bigger wins, and 22% said I would have been one that said I'm very happy with my trading. Let me ask you, Mike, is 22% better than 4%?
Oh yes, absolutely, Kurt.
Absolutely. Okay, so just what I've shown so far would have helped you. Okay, what I showed so far, 2 things. Number 1, use a put option to protect your stock. And keep the risk down to single-digit %. Number 2, diversify enough that your portfolio only could be hurt by 1% for each of those positions. Okay? All right. So first thing we're going to do is we're going to take back the edge. I'm going to show nested spread trade number 1 here. Nested spread trade, I call them income methods because they're almost always done at a credit. Okay? But sometimes they can be done to guarantee a higher payout. We're going to see that a little bit later. Now, I'm reviewing this, okay? We already showed this one where we have Humana shares at cost basis $63.90. We've got put options that are 5 months out in time, okay, because it's March and we're doing this in March, okay, but we're buying an August put. So we've got $4.70 per share at risk, right? Bless you. And remember, it's scalable, okay? So if we get into 200 shares, that's great. But then we'd still have only 6.7% of what we put into the trade at risk. All right, so here we are with 200 shares. I've got $940 as my dollar amount risk, okay? And 6.7% of the overall, it's like about 14,000, okay? 13,940. So out of the 13,940, I could lose 940. So I've got 6.7 at risk and an unlimited upside potential, correct?
Mm-hmm.
Okay. So that's where we're starting. That clearly shows that we're risking 940. Now, let's look at a bear call spread on Humana. A bear call spread is when you sell a lower strike call and buy an upper strike call. In this case, Mike, I get a credit of 50 cents per spread.
Okay.
Cool? Okay. So that credit of 50 cents per spread, that's income.
Mm-hmm.
If I do 2 spreads, okay, which I can do because I've got 200 shares of stock.
Sure.
If I do 2 spreads, then that's $100. See where it says total cost and the cost is negative?
That's right. We receive a credit of $100 into our account.
Yeah, but there's a dark side to this. I'm getting $100 up front to do this play, but there's a dark side. What's the problem here?
Well, looking at this chart, we see that what we want to have happen is the stock stable of 67.5, so all of the calls expire worthless, and we keep that $100. If the stock goes up and is trading above our upper strike price, well, we're going to have a loss of roughly $250 per spread, or $2 per spread if we count the 50 cents against it. So we're risking
Right.
$400 if the stock moves up in order to make $100.
Yeah. The good news is we get $100 in the front end. The bad news is if the stock goes up, because this is a bear call spread, okay, we have a bearish, near-term bearish expectation. If the stock goes up, well, we're on the hook. We could get hurt. Okay, we could have to pay back 500, and so it's a total loss of 400. Not cool. Okay, so this risk-reward graph shows two 67.50 $70 bear call spreads generating 50 cents credit each, or $100.
Mm-hmm.
Okay, now let's consider this, Mike. We've got the RadioActive Profit Machine with 200 protected shares at 940 risk, and its duration is till August. We've also got this other position I call it income method number 6, which is a bear call spread nested within the RadioActive Profit Machine. It's nested within the ownership of stock that Mary Put represents, okay? And times 2 contracts, that's $400 risk. It's going to be over with in April, but the net risk is what? If we could lose 940 here and lose 400 there, what's the net risk, the combined risk?
Well, looking at the two positions separately, we'd say that the risk is $1,340 now against the position. Okay. But considering one is done in the context of the other, that's not what happens.
That's right. You see, this bear call spread collects $100, and that $100 comes off of the cost basis of the stock.
Mm-hmm.
Yeah, that means that I'd only have $840 at risk. Now, because I've got stock on hand to share, there's no risk to doing a bear call spread.
Right, because if
say it again.
Go ahead.
Yeah. Well, you go ahead. You're going to say it. Go ahead.
Well, I was just going to say that since we own the stock, if the stock did move above 70, where we'd lose on the bear call spread, we have the stock to counter the effects of that because we're gaining on the stock while we're losing on the spread.
Yeah. Yeah. So the whole point is here that this $400 risk goes away. It actually goes away. Okay? And so instead of 940 risk plus 400 risk equals 1340, no. It ends up being an 840 risk net. The stock that you own has to go up more than enough to cancel the loss on the bear call spread, right? And so you can't lose without winning. This is the power options graph of both plays. And Mike, what happened in reality was that the stock did go up. If you look right here, the stock is up beyond $70 a share. Well, what happened? Well, remember I had the stock at a $63 cost basis. Okay, the stock happened to go up. I had to deliver it at $67.50, but I've been paid to own. Let me say that again. I've been paid to own 2 calls because it's a bear call spread, right? I'm delivering the $67.50, but I've been paid to own these $70 calls. And guess what? The upside is still unlimited. We don't have a 6.7% risk with infinite upside potential. We got a 6.1% risk now. We don't have 940 at risk with unlimited upside potential. We have 840 risk. And there's more time left to this because of the staggering. We've got August puts and we've got April calls. So this bear call spread, when it's done correctly, introduces no risk even though it takes a credit. Is that cool or what?
Now,
I mean, go ahead.
Oh, Kurt, I was going to ask you, what happened with the, CW posted a question, but can the stock get called away? Well, that's a possibility. It depends on how your broker handles it.
Right. Right. Either you will manage your income method number 6 play with one of the tools and techniques that we have in the blueprints. Either you'll manage the income method number 6 play, or you'll deliver your stock. But guess what? You're delivering it at a profit because your stock was at a lower cost basis, right?
That's right.
I got the stock at $63.90 and I sold $67.50 calls against. Okay? But what's really cool about this is, Mike, if that were just a covered call, that's all I could make, right?
Oh, that's right. Yeah, if we had just sold a call against it, sold that initial 67.5 call against it, if the stock went up to 75, you either have the choice to pay back the $8 or $9 to buy back that call to stay in the stock, or you've capped your gain and don't have the unlimited upside.
Right. But in this case, I left the upside open. Left the upside open because it was an income method number 6 play, taking the income. Kind of cool. Okay. All right. So to see if your radioactive profit machine is a candidate for income method number 6, you'd use the tools here at Power Options. Okay. I'm going to send that link to everybody for a free 2-week trial subscription to RadioActive Trade. I'm sorry, not to RadioActive Trading, to Power Options. And Power Options is not me, okay? Power Options is the company that Mike works for, and they have the greatest platform in the world. Mike, are we showing that screen again where,
Yes,
where you can't lose without winning? Okay.
The risk reward. Now, yeah, just to clarify what CW said, and this is, I've seen this happen to me in different accounts. One is a cash account at Options Express, one is a retirement account at Fidelity, where I'm not allowed to do spreads, but I can enter this particular income method in my IRA, because when I have the married put and I sell the call, my broker just sees that as a covered call play, and then I just buy an extra call. Now, in that case, if I didn't manage it and the stock went up, they probably would take my stock from me, or I'd have to buy the call back to avoid it. But I'd still have the long call gaining in price, as you mentioned, Kurt. Now, in my cash account at Options Express, when I have the married put in place, I get a better commission fee by entering a bear call spread. So when my broker sees that this was entered as a bear call spread, they just fill the loss of the bear call spread, and I still have the stock.
Right. It kind of depends on that. So you know what? We actually took a few questions. Are there any other questions that we should handle right now, Mike, before we got into income method number 4?
Let's see. There was another question that came in. Corrado just brought in a question, but I think this is something that's better handled as an email. Corrado, what I'd ask you to do is send your question to support@powerop.com, and it's for 2 reasons. Number 1, it's going to require more time to answer this question than we have left in the webinar, potentially. And number 2, it's more of an advanced concept, I think, of someone who owns the blueprint, and we don't want to give away, total discussion of management. It's a question I face. It's a question I'm facing right now, actually, with one of my positions, what he has. I'll just let everyone know the questions. He says, well, you have 6 months protective put. You're 2 months close to expiration, so within 60 days. The stock has moved up and maybe slightly down, and right now you have a 5% loss. What do you do? Well, I've got a position like that, and the blueprint discusses that. There's, things that you want to do to evaluate your SIGA model for every one of the income methods and when you're looking to adjust a position, and that's what we'll kind of point you towards when we get your email, Corrado.
Right. Yeah. Folks that buy the blueprint get support. So is this person an owner of the blueprint, Mike, the fellow that wrote in?
I'm pretty sure, yes.
Okay, then we'd be pleased to help them with two management ideas. So, sir, go ahead and put your question in written form to support@radioactivetrading.com. That's part of your purchase price on the blueprint. Okay, so you get support on that question. Okay, Mike, I'm on your SLW trade. Okay, and again, it's a dated trade, but we're going to show some current ones here in a moment. This is the one that I sent out with today's email, and it's something that I have numbers on. Okay, so anyway, you had bought shares of SLW, Silver Wheaton, at 17.20, and then you went out 7 months in time.
Yes.
And bought a December $20 put option for $4.30. Now, a lot of folks look at that and say that that's expensive. But then again, I'm going to counter with this. The fact is, Mike has only spent $21.50 total for an asset that has a minimum face value of $20, right? It's
I'm guaranteed to get $20 back no matter what happens.
Right. You could have bought a cheaper put option, but that cheaper put option would not give you as good of protection. It's like going for the real cheapy insurance policy.
Yeah.
You're going to have a huge deductible, right? So this is actually, it may seem expensive, but really it's not. Instead of looking at the $430 as an expense, why not look at $280 of it as a deposit and $150 of it as, well, that's what you're really paying. And since this is this 5 months away? 7 months away?
7.
Okay, let's say it was only 6 months away, just to make the math a little easier. Okay, that's 25 cents a month to protect it, to protect your stock position. Okay, so what you've got to do is you've got to figure out how to make more than 25 cents every month. Well, that's doable. here's what your married put looked like, Mike, way back then. You had a 2150 investment per 100 shares.
Yes.
And how many shares did you actually pick up?
I believe it was 300 on this trade, so it was investment about
300.
64.50. Yeah.
Right. Okay. So in truth, you've got 64.50, of which you could lose 150 per share, or you could lose,
450.
450. Right. So your asset was guaranteed to still be worth $6,000, even though you put 64.50 into it. It was going to be worth $6,000 no matter what.
Mm-hmm.
Right? And had unlimited upside potential. So you could lose 7%, but you had unlimited upside.
That's
Okay?
right.
So let's talk about your reasoning here. What did you do, when, and why?
Well, over on the left here, you see the pullback. I was watching this stock, and you see the pullback here where it sort of touched down to that lower band, and then it came back up, and then it went down again. That second drop, I think, is where we got into the position, right a little bit above $17 per share. And then, of course, as
Right,
we
here's
went...
where you bought in. Okay.
No, back in May, over on the far left there.
Oh, right.
Yeah, back right in the middle. See where the pullback is, and those two ones? I think the second one, where it dropped down the second, it went up a little bit, then came back. I think that's when we got in, was the second one here.
See.
Yep.
Okay,
now, in the first 30 days, the stock moved from 17.20 up to, we look around June 20th, June 25th, the stock's up around $21 per share or so, and going a little bit higher. And then it peaked out, and then it went back up.
Okay. So income method number one, I'm going to go ahead and give it away, Mike. Income method number one, there's 11 different income methods. Income method one is going to be familiar to at least 6 in 10 of our audience members because 6 in 10 of them are doing it. They're doing covered calls.
Mm-hmm.
Okay? So SLW had opened at 21.45, and you said, okay, I'm going to sell to open in August, not December, okay, but
right.
August $21 call, and you got $1.48 per contract, correct?
Mm-hmm.
Okay. And so that was June 28th, okay?
Yeah, I was trying to get filled at 150, but the market maker wasn't having it, so I took $1.48.
Right, okay. So you're nearly bulletproof. I mean, the amount of risk that you had was $1.50.
Right.
Your cost basis was $21.50.
Mm-hmm.
And you're getting filled at $1.48 to sell your stock at $21. So that'd be $22.48 in, plus you'd still own your put option if you got called out, right?
Right.
Okay. So you're just about bulletproof. Here's how the chart looked after that, okay? How the risk-reward chart looked.
Mm-hmm.
Mike has got, he had $1.50 at risk. Now he's got 2 cents at risk per share.
Right.
2 pennies. So for every, what is it, every $2,000 and 22, blah! For every $2,000 you've got invested, you've got $2 at risk. So
exactly.
About 0.1%.
Mm-hmm.
Okay. If you get called out, it will be an 11.6% gain.
Well, yeah, in this situation, when you do sort of the time spread, what we sometimes call a dynamic collar, but by selling the shorter term August and still having the December put, the best case scenario is the stock's trading right at or just below that short call strike price. Mm-hmm.
Right, okay. And what happened, in fact, was it fell a little bit short, right? Here on, is this expiration Friday? Is it near expiration Friday?
That was expiration Friday, yeah. I held it to that position, and the stock was just wavering around that 21 strike, up to 21.10, then down to $20.80, and back and forth the whole day. So,
right. So by buying to close these 3 calls, you just didn't want to get called out at the end of the day, right?
Right.
You added 3 cents of risk back into the position. So now, poor baby, you had picked up $1.48. By managing it, it ends up being $1.45. So this is what I had put out in the newsletter today, the email today. So far, I've shown exactly what was in the email. Okay, now we're going to go beyond that.
Mm-hmm.
So what you have is an at-risk amount of a nickel per share. Or since you have 300 shares, your at-risk is $15, okay?
Mm-hmm.
You could lose a nickel or $5 for every 100 shares. Okay, or for 300 shares, you could lose 15 bucks.
Right.
Okay, so your initial investment had been $64.50, and if you lost, you'd lose $15. Wow, big whoop.
Big whoop, right?
What's missing here in this married put graph? There's something missing. I don't understand what's gone.
Well, there's no break-even line.
Right.
And there's no risk.
Right.
Well, there technically is a break-even line, I should say, but yeah, there's really no risk. There's no red at the bottom, yeah.
Yeah, it's so small that it's not even visible. In fact, Mike, if your stock plummeted at this point, if it plummeted, you could get out of your stock and your put separately, and the time value in the stock would be equal to whatever's in this red line, right?
Uh-huh.
Yeah. So you're pretty much bulletproof, okay? Now, by using the income methods, you used income method number 1. You had a married put play that had 7% risk, right?
Yes.
Was your cost basis. The dotted line is your cost basis, right? And the hard black line down there, that's the floor of how much you could possibly lose. Even if the stock plummeted down into the red zone here, all you're going to lose is this. Now, by using income method number 1, which is selling and covered call, you reduced that risk. And in fact, this isn't to scale. You reduce that risk from $1.50 to 1 nickel, right? Okay, so that's the income method number 1. Now, it's possible to reduce the gap to less than 0. And since there's more than one income method,
excuse me,
bless you, right after that, you could actually, and you did actually, use one of the income methods to raise your payout to higher than what your cost basis was. Your cost basis for your stock and your put, but your put strike price is higher than the cost basis. Mike, that's heads you win, tails you can't lose.
That's right.
We like to call it bulletproof. Okay, so now what? Well, SLW continued up in price, and you considered, should I use income method number 1 again? I don't know. Or should you use a different income method to bulletproof or earn extra income? And so you went to my book, The Blueprint.
And I evaluated the SIGA model for each of the income methods to decide which one best suited the current conditions, my expectations, my goals, and that determined my actions.
Right. And then, of course, you were able to get a visual on it using your Power Options platform. Able to get a visual on it. So here's what Mike did, folks. I'm going to go ahead and, Mike, I'm trying to help you save your voice there, but please jump in.
Yeah.
Because you have a better understanding of your trade than I do.
Yeah.
Okay.
So the stock had continued to move up in price. Remember, we're still holding the December 20 put that has no risk, and I think this was in September. So what I look to do is sort of ratchet up the insurance. Now, we saw earlier, Kurt, your income methods, as you discussed. You showed an income method number 6, the bear call spread. We talked about income method number 1. What we did here is we sold to close our December 20 put for $1.10 as the stock had moved up, and we bought to open a December 24 put for $2.70. So now technically, I'm putting $1.60 into the position. I'm adding to the cost basis of my current position.
And that's $1.60 per share, so you've got 300 shares and 3 contracts. So
I'm putting in $480. Yeah.
$480. Okay. All right.
But by doing this, I guaranteed a 4-point higher payout. Now I'm guaranteed to get $24 back, so we've increased it to a payout of $24 per share. We did increase our total cost basis up to 21, what is that, 65? 21.65? Yeah. But now we're guaranteed
$21.65 per share.
Now we're guaranteed to get $24 back, so our risk now is a negative value. We have a negative risk of $2.35, meaning if the stock went to 0, we're still guaranteed to make $2.35, which is a little bit over 10% on this trade. I think it's 11.8% at this point. And if the stock goes up, we haven't sold a call. We didn't do income method number 1 again, so we still have an unlimited upside profit potential.
Now, Mike, this is why I call this the ATM machine, because an ATM machine kicks out money, right?
Yes, that's right.
But it only kicks out money when you've got money in your account. Before you make a withdrawal, you have to make a deposit. And what Mike did here is he made a deposit of $1.60, okay, times 300 equals $480, right? He made a $480 deposit, but he's guaranteed now to get back at least 235.
That's right.
How about that? And 235 times the 300 shares equals, well, it equals, no, that can't be right. It should be
no, it'd be $2.35.
Right? What did I do wrong here? Okay, 2.35 a share, right, times 300 shares. You're guaranteed to get back a $705 profit.
In the worst case scenario.
Worst case scenario, but the upside's still open. See, you've got a Mary put play in place. It still has infinite upside potential, but now the risk here is expressed as a negative number in the Power Options platform. It's a negative number because your cost basis has been reduced by using the income methods. Very cool. Okay, so Mike, you did it again. You did it again. What happened here? Let's describe it.
All right, well, as the stock continued to move up, and this time it was, a little bit above 24. Raj did ask, so you swapped the higher strike put when the stock rose to 21. Yeah, it was a little bit over 21 when I did that first income method number 4, Raj, and here it was a little bit over. Again, this isn't the exact price. These screenshots were taken later, but the stock was a little bit above 24. So we sold to close our 24 put for 220. We only lost 50 cents on the put, and then we bought a 27 put for $4. So we're putting in another $1.80 into the position, into the ATM machine, adding it to my cost basis of $1.80, but guaranteeing to get back $3.
Okay, so you spent another $1.80, right? Times 300. This is what you spent. Okay, $5.40.
$540.
But you raised the strike price by $3, right?
Right.
So $3 times 300 shares equals, okay, you made a deposit of, what is it, 540? No. Yeah, 540.
Right.
But you're guaranteed to get back 900. You deposit 540, you get back 900. That's a good trade to me. Okay, and so after a while you continue to do more income methods. We don't have to share what those other income methods were, but we've just shown income method number 4, ratcheting it up. Eventually, did you close it shortly after this period here, Mike, when it was at negative 22.9% risk?
Oh, here's the next one. That is true. This position was this trade was probably done in November, where we rolled up. We actually rolled out in time and up to a higher strike. So we rolled up to the 32 put, and the stock kept going up. But eventually, a couple weeks later, the stock hit $40 per share, and I said, okay, I've had enough. So we liquidated the position shortly after this point, where we had the guaranteed profit of 23%, again, in the worst case scenario, and we still had the upside.
Right. Now, I want to point something out, Mike. Your first investment was $21.50, right?
Yes.
But you kept putting money into the ATM machine. You kept putting in more money into each of these spread trades because it's a debit spread, right? When you do a barrel spread.
Yeah.
It's a debit spread, so you kept putting money in. But the return that we're talking about here, this negative 22.9% risk, that's a return based on everything that you've put in. It's not a return based on the stock only, which would be kind of an inflated way of saying things, wouldn't it? And it's not a return based on just what your options are doing. It's a return based on everything that you've put in. You've put in 2603 times 300 shares. Hang on just a second. I got to get out this calculator again. 2603 times 300 shares, okay, is going to be, you put in this much plus your commissions, right? 7809 plus, I guess you've done at least 5 transactions here of, geez, did it cost you like $50 in transaction fees, perhaps, by this time?
I think I'm not sure if this slide presentation that you have is. I know the slide presentation that I used that you based this off of did include my commission costs. Anyway.
Okay. Well, the point is, rather than waiting until expiration, Mike, you just sold everything. You sold your stock and also the put options that you had, continued to roll up. You sold your stock and your put options separately, so instead of a 22.9% gain, you had a 59%.
Right.
Pretty fabulous. Pretty fabulous. Okay, well, let's just work off of just the this, okay, times 1.598, and this will give your return at the end. You started with 64.50, and now you have 12,478.
Right. Mm-hmm.
Wow. That's about double, really. But you know, we're considering the fact that we continue to make deposits too. Okay, you couldn't have made this work without making deposits. But the point is, you started with 64.50, ended up with $12,000. Pretty cool. Okay. All right. So, folks, I'm going to ask you to ask us some questions. Okay, by reducing the gap to 0, but still leaving the upside open, Mike was able to continue to roll SLW up. I did something similar with Marvel before it got sold to Disney.
Mm-hmm.
One of our clients did something even better with McDonald's. He was able to take his McDonald's stock and get this. While he's sitting on it making dividends, collecting dividends, he also was able to do one of our other income methods that I call "Gimme My Money Now." He was able to use "Gimme My Money Now" to pay for his insurance. So his put option actually came at a credit. Really crazy. Okay, so folks, let's go ahead and pose questions regarding the ATM machine. Tell me what you think about that.
Well, Nancy,
go ahead.
Hey,
I'm gonna run a poll.
Stuart, thank you for the question. Nancy, first off, Nancy asked, you know, when did you actually close the trade? I think it was December 7th or December 8th of 2010, somewhere in that time frame. Stuart asks, what do you think you would have happened if the stock went down as much as it went up? Well, that was the TLM example that we're not showing. In the same year that I had this trade, I opened a stock, Talisman Energy, that was about the same price as silver wheat, and it was around $19 or so per share, bought the 21 put, Stuart. In the next month and a half, the stock just went straight down and was trading at about $11 per share. And there are income methods in the blueprint where if your stock drops 5-10%, you can do some adjustments on the downside. But with a drop of 50%, it's just time to say, you know what, everyone who traded this as a covered call is down 48-49%. Everyone who bought stock is down 50%. My max loss right now is about 4.5%. My max risk when I opened the position was 6%. Since we're only a month in the trade, I could close out for less than that. So I might just liquidate it right away for 4.5%. Loss. And I'm fine with that because the other trades allowed me to leave the upside open and take advantage of a potential 59.8%. Now, don't get me wrong. I'm not claiming I do that every time. In fact, I don't think I've had other double-digit gains in the past 2 years, but I haven't had anything like that gain since then.
Right, yeah. Yep. Let's see here. Mike, I don't know that everybody knows that there's a poll up there, so I'll call your attention to it. What objection do you have to using a married put? Why would you not begin trading this way right away? Okay. What biggest objection do you have against using married puts and using them the radioactive way? Okay. All right. Let me go ahead and close that poll because now we've got a whole bunch of folks coming in. 3, 2, 1. Okay. 29% say no objection. I've used them before and they saved my bacon. Okay. 43% say no objection. I just don't know enough about how to do it. 19% are still not convinced. They say it costs so much to have a put. Okay. I would make more without them. Well, maybe you would. Maybe you would make more without them. But
you'd also lose more without them as well, and that would counter any of the wins that you had. That's
and
the
we
trade.
already showed, using the martingale principle earlier, we already showed that losses make for exponentially higher returns that you have to have just to get back to where you started. It's exponential. And so what that means is, well, geez, if you could cut your losses down to 5%, even if it took 5% off of your gains, you've actually skewed the odds in your favor. Most folks don't realize that. Okay? 10% say other objection, we'll text it in. So let's see those texts. What other objections do you have to using married puts in order to keep you out of trouble? This isn't the correct poll here, Mike, but I'm going to put it up there anyway. What did you get out of today's lessons? Do you see yourself using what we gave away for free today? And Mike, do you have those current examples queued up?
Yeah, and Gary just asked what screens would I use for the bear call and power options, and we're actually going to show that.
Yay!
Oh, okay. Zaki might have come in late. ZAKI says, you guys suggest a single trade to represent 1% of the total portfolio. We don't. What we said earlier is that any married put I open will have a risk of 6.5%, maybe 5, 6, 7% of the capital I invested. But I make sure that that monetary amount doesn't risk more than 1% of my total portfolio. So if I have a $50,000 portfolio, one trade that we'll look at in a second has about a $500 risk, so I did 100 shares in one put. Another one has a $120 monetary risk, so I did 300 shares in 3 puts, so that my risk on the position is always less than 1% of my total portfolio value.
Very good. Mike, this particular poll had it was possible for you to answer more than one, so the totals are going to add up to more than 100%. But I said, what did you get out of today's lesson? Do you see yourself using what we gave away free today? 17% said, I've come to a number of radioactive trading events and it's helped already. 44% say, I see how using a put can keep you out of trouble. 44% said, I see how leaving the upside open can increase returns. You know, when you sell a covered call, for example, or do a bull put spread, you can't increase your returns if you were right about your stock's directions in the first place. But you can with the married put. 39% say, I need to know more about these income methods before trying. Agreed. Guess what? A lot of folks will come to this thing. They'll see what I'm showing is just a snippet, a sample, and they say, oh, I see what you're doing there. You just buy stock, buy a put, and sell a call. Let's go to the races. And they do it wrong. And the thing is, guys, don't imagine that with 10 years of experience behind doing strictly this kind of trading and networking with thousands from all over the world in 30 countries that are also using it. Don't imagine that out of a 1-hour seminar you've learned everything you need to know. I'm going to say it might be helpful for you to get some more information.
Mm-hmm.
All right. Mike, are you ready to take that screen from me?
Yeah, but hold on a sec. I'm actually going to do something different here.
Okay.
I am going to get to that. I need to find something real quick, Kurt. While I'm pulling up what I want to pull up here, what I'm doing here is I have a small presentation somewhere on my desktop, I hope. There it is. Okay, I want to pull this up. This answers a question real quick. Stuart asks, I wanted to address this. Stuart asks a question, what happens in a market crash where every position is sinking? In other words, you're losing 4 to 5% each time. Okay, well, it's better than being in a covered call, better than being a stock, bull, put spread, any kind of spread that's losing much more than that. So, yeah, I can do that. But
you're in bulletproof positions right now.
Right. But one of our examples, Stuart, one of my first married put trades on Office Max that I opened, the stock went down 50% over the course of a 5-month period, and I actually got out of the position for a 1.8% gain following the rules in the blueprint. And I'll take that as opposed to having a 50% loss, for example. All right. We had a lot of questions.
That was in 2008, was it?
I think so, yeah. Mm-hmm.
Right. So you're chasing it down using the income methods, and instead of a 50% loss,
right,
you're long on stock the whole time, you get a 1.8% gain.
Okay.
Okay.
Now, I am going to steal the screen from you, Kurt, and it doesn't, I'm going to try to show one of the examples of the current trades, but we're running out of time, and I think this is actually more important to show.
Okay, let's do it.
And we had a question come in, and Robert, I apologize if my, sorry folks, this is doing something, there we go.
I'm losing out on sound here, Mike.
Am I back now?
Okay.
Okay, Kurt, stop.
It's
there. Okay,
it's
stop.
saying, yeah.
Am I back now?
You got it. You got it. Yep, go ahead.
Sorry, folks, this selection process went a little strange here. So, again, in addition, I still have about 4 or 5 questions that came in I want to get to. And, Robert, I apologize if you thought my answer was kind of short and trite, but here's the reason. Robert said, the married put is the same as a long call. And my response was incorrect. Let me show you why. This is the big detraction we get. The setup is the same. It's a parity as buying a far out of the money long call. So if I bought stock on silver wheaton at 17.20 and I bought the 20 strike put for December, someone would say that's the same exact trade as just going out and buying the December 20 call. Well, it's not the same. And something can't be the same but better. That doesn't make any sense. Here's another RPM from 2011. I bought shares of PXP at 35.08. Bought the January 40 put at 7.25. Now the total invested then was 42.33. I'm guaranteed to get 40 back, so I'm only risking $2.33 or 5.5% of the position. Okay? Now, on that same day, I could have bought to open the January 40 call out of the money, same expiration, for 2.30. Of course, the long call has an infinite maximum profit, so the maximum risk is $2.30. So automatically, Kurt, this has to be a better position because we're risking 3 cents less, right? Yeah. I had $2.33 risk in the married put, and the long call here has a cost of only $2.30. So it must be better. Well,
it is apples and oranges, but
yeah, we have this. Here's the risk-reward profile for the married put we had on PXP on June 20th. And here's the profit and loss chart on the long call. I didn't copy and paste it. These are actually two different things. They look exactly the same. Okay. Oh, and this also goes to CW's question where she's asking about why is the leap, we had another discussion, why is a leap call a lie of leverage? Doesn't buying a call give up the right to buy the stock at the strike so you could convert to stock if needed, have other income methods apply the same? That's a different discussion, and I'll tell you about that show later on. You're talking about an in-the-money long strangle, which is different as well. I went through all these things, guys. When I first found Kurt 4.5 years ago and we started partnering up, I tried every example of entering the married put as a calendar put position using a naked put, using a leap call, using the ITM leap strangle, and believe me, every position I tried that on would have done better with the married put. But let's go on with this discussion. To me, the most important thing, and Kurt has other blogs on RadioActive Trading that talk about the Black-Scholes pricing model, while the long call is not the same as a married put, but to me, it comes down to the matter of discipline, Robert. Here's the deal. The long call and the RPM have a similar risk-reward profile. We're not denying that. Problem comes with discipline, okay? Proper money management and forcing an ideal-sized trade. The long call risks 100% of what you invested in the position. My married put, I'm only risking 5.5% in this case. But you're going to ask, the investment's only $2.30. I'm okay losing that. But is that what you're going to do? Are you going to buy one call to only risk $2.30? Let's be honest about investors, okay? Let's compare the two trades side by side. Over on the left here, we've got both accounts at $100,000. Both of us have free capital to trade $17,000 in our account. My married put is going to cost $42.33. My risk, of course, is 5.5%. With my 17% capital, I can invest $16,932. I could buy 400 shares, and that would take me to $16,932. But look, total risk on my portfolio is less than 1%. With a call cost of $2.30, if you invested the entire $17,000, you could buy 73 contracts. Now you're risking $16,790 of that investment, or 16.7% of your total portfolio. Okay, let me be fair. That's an extreme example. I know, Robert, that you wouldn't go out right now and put all $17,000 into long calls on one trade. But you're also not going to buy only 4 contracts, most likely. And if you did have the discipline, if you saw me open that PXP position where I bought 400 shares and 4 puts, so I had the risk amount of $932, and you said, well, I'm going to do the same. I'm only going to buy 4 calls, so I'm risking the $2.30 times the 4 calls. What are you going to do with the remaining $16,100 you had? Are you going to put it on hold in your account, or are you going to buy long calls on other stocks? You're going to use that capital to buy 5 contracts of XYZ, 5 contracts of ABC, maybe 10 contracts of CSX. You're going to invest more in that, so you're going to be risking more money on the position. And so here we see the side-by-side comparison. It is only a parity trade, Robert, if we had the same example where we had $17,000 of free capital. If I bought 400 shares and 4 puts risking $932, if you bought 4 calls and then left the rest of that $16,080 on hold in your account and did not use it to purchase any other trades, that is the only parity trade. But let's be
Right.
real.
And I'll also interject and say, actually, that has to be in an interest-bearing account.
That's true too.
Because part of your pricing model is also risk-free interest.
Mm-hmm.
So that $16,080 has to be in an interest-bearing account for the two positions to be at parity.
That's right.
And even then, when you have a married put instead of a call, you know what? Some of the adjustments that we show are very low risk, but brokers won't allow you to do them against a short call.
That's right.
Against a long call.
Yeah, if you can't do spreads, then you won't be able to
would.
do that, right?
Yeah, where they would allow you to do it against a married put position. So, that's why we show the married put position. And a lot of folks will keep beating the drum of a married put's the same as a long call. No, it's not. I presented this material to folks at MIT in 2008. The room was full of economics PhDs, and not one of them called me on it. In fact, I made the assertion it is not a synthetic equivalent and not parity, and nobody disagreed because they had a room full of really smart people. So, okay.
Another question that came in real quick from John is, he says, I'm sorry, my real concern is how much income is possible each month. This is a danger, and it's the philosophy of almost every trader, but you have to be careful with that. You know who the people who get burned the most? The people who focus on trying to make 3% of income each month. Those are the people that end up losing the most, to be honest with you. Now, I'm not going to guarantee anything, of course, and you said that, but just some general idea. I don't concern myself with monthly income, John. When I'm opening a married put, and Gary asked, can we run a search? I don't think we're going to have time to do that today, unfortunately, because we are running out of time.
Can I handle that question?
Sure.
That'd be all right. It's John that wants monthly income?
Yeah, that's asking what is possible with monthly income.
Okay. John, RadioActive Trading is more about cutting your losers short and letting your winners run. So if your winners are still running, you don't want to stop them. Mike would not have gotten a 59.8% gain in 5 months if he had been concerned with doing, a 3 or 5%
Excuse me.
Gain, 1 month and maybe not getting it the next. It's a different instrument. The blame rests on these covered call gurus that try to convince you that selling covered calls is like running a business. It isn't. If you want monthly income, there is an instrument that's available. It's called a bond. You'd buy bonds that give a dividend that pay you some interest, or you could buy a liquor store or gas station, with your capital in a good enough place, and you could expect, to get a monthly return. But as far as in the stock market, it would be irresponsible to say you can make 3 to 6% per month. There are folks that do that, but we're not that irresponsible. What we do say is, hey, you can't lose more than 6%. Wouldn't you rather have honesty? Wouldn't you rather say, geez, I can't lose more than 5% or 6% or 7% in this trade, but I've got blue skies? Okay. Mike, I've put up a poll here. I'm going to go ahead and take her down. And
yeah, the other thing I was going to say to John is that in reality, I'm sorry, looking at my positions, last year it was about, with my married puts and even the webinar example we did on power options, the webinar portfolio, the covered call portfolio over the course of the year was up 2.3% with common management techniques applied. The married put was up 12.2%, and my RPMs were up a little bit higher than that. So I could say I average 1% per month, but I don't look at that. There are several, I might open a married put and for the first 2 months do nothing, do no income methods because it doesn't make sense to do it without putting myself in a worse position. But in the 3rd month, I might liquidate the position for an 8 or 9% gain. So you could say I generated 3% per month, but I didn't really generate any income. My more concern is what is the return when I close the position and using the income methods, using the income methods correctly by what's in the blueprint and not trying to force myself to sell income month by month by month.
That's right. Mike, are you going to show those current Bulletproof trades?
I mean, we're at 130, Kurt. We may, unfortunately, we'll show what we're looking at right now because we promised Gary we'd do this. A couple of questions came in. Yes, folks, you can do this on ETFs. Kurt's done it on DIA and so forth and other positions as well. But what I'm showing, oh, you got the poll open still, Kurt.
Yeah, I opened a poll, just a final poll. This is the last one, folks. I'd like for you to take a look at this while Mike is getting ready. And Mike, do you have your screen ready?
Oh, yeah. Mm-hmm.
Ready to go? Yeah? Okay, good. So I'll just go ahead and cut this short here after, 5 more seconds, okay? What's your single biggest objection to getting the RadioActive Trading Home Study Kit right now? No objections, seriously thinking, let's hear the offer. Or I've gotten excited before, but then the claims fell through, $600 is a lot of money. Or I don't know if I believe your guarantee, or you give so much away free that I'll just keep going to webinars. All right, that's honest. All right, Mike, let me go ahead and share the result. 11% said, you give so much away free, I'll keep coming to webinars. Yeah, we've shown income method 4, income method 1, income method 6, income method 5, but we don't show them all, okay? But yeah, I'm glad that you're learning a lot. 56% seriously thinking. Let's hear the offer. Mike, I'll prepare the offer while you go ahead and show the current Bulletproof trade, just one of them, right?
Yes, I could show one of the Bulletproof trades and what we might be able to do, and I'll actually show a very, very current trade that we might be able to do something, we're looking to do something with right now, and a comparison. I want to do a comparison real quick. So I'll be as quick and as thorough and as clear as possible. Here's the profit and loss portfolio for power options. Here are a couple of the positions that we're looking at. Potential here for Johnson & Johnson was opened at $70 per share, bought the 72.5 put for $650. That's a January 14. It was a leap put. Lowered the cost basis already to $69.39 for the stock, 61 cents down. And the stock's now trading at the put strike price. So we're looking at an opportunity to do income method number 4 on this particular position. It doesn't bulletproof it, but it's going to cut our risk from about 5% to about, it's going to cut our risk almost in half, from about 5% to 2.5%. Now, what I think we're going to look at first is this one here that's close to being bulletproof. WNR was open on October 27th, I believe. Opened the stock at 26.27, had the March 29 puts getting close to expiration at 470. But we've lowered the cost base of the stock to 24.38. Using income methods and actually a special dividend that was paid. So what I can do here is I'm going to go to position actions and position analysis. We're going to look at this first, Gary. This is the first tool I mentioned when you said what tools can you use. And this is going to give me a breakdown here of my current married put position. So we see based on my numbers, my new effective cost per share and my put value, my maximum risk on this position is 0.3%. So it's pretty much bulletproof right now. If we liquidate, we can make 4.7% after 75 days. Now, it's not doing income method, just liquidate it right now. Okay? Now, we've got the March put, but we see here there's some income methods that are listed. I could simply sell a call against it. We could sell a February 29 call and collect 90 cents, and this would be a max return of 7.2% potential, and we'd be bulletproof to the tune of 2.9%. Or, if we wanted to, we could use income method number 4s, as we saw earlier, and we could sort of drop the risk down here using the March 30 put, keep it at around that 0.3% risk. I probably wouldn't do that because it's not dropping the risk as much as I'd want. But what is the issue here? Why would we do this? Let's take a look at that February 29 call, possible 7.2% max gain, bulletproof the position to 2.9%. Well, it's great to see things numerically, but using this tool you can go to Simulate Trade. And here we see our side-by-side comparison. So what we're looking at here, the red line hockey stick graph is our current married put position with a gain of 4.7% right now if we liquidated and a risk of 0.3%. The blue line shows us what our new position would look like if we sold the call. Now we're going to cap our gain, and that's why I said max profit of 7.2%, but we'd be bulletproof to the tune of 2.9%. So worst case scenario is go ahead, Kurt.
So what those numbers mean is that your worst case scenario is you make 2.9%, and your best case scenario is you make 7.2%.
That's right.
But you can't lose anything.
And that's right. That's exactly right. So that's one of those methods that could be done here. We just wanted to show the tools. Now, I might actually do something different with this one, a different version of income method number 4 than we saw today, as I mentioned, Kurt, because we're pretty close to that expiration. I might actually use an income method number 4 and roll this March put out to a higher strike, but out to July. So I add 100 days more time value and put the risk up to only 1%. So that's a possibility as well. Now, WY. This is a 7-day-old position. It's in the Fusion account for our Fusion subscribers. Got in at 29.10 and bought the 30 put for July at 275. And the stock's up to 30.48. We gave a little bit back on the put, but it's above our put strike price. So I don't think I can bulletproof with this one, but there are opportunities now. And another way I could do it is let's go to the profit and loss chart. This was the tool that Kurt kind of showed earlier. Here's my trade. And it copied over everything for me. There's my trade, 31.85 invested, risking 185 or 5.8%, and the upside is unlimited. It's just above the put strike price. Now with this particular position, what I can do is say, what if I wanted to sell to close the 30 put and roll it up a little bit, buy to open maybe the July 33, for example, or 32. Well, let's take a look. I'll go into View Options here, and on the fly, we'll go to our July expiration. Shows me the 30 put has already been added, but I'm going to go ahead and click that again. So it puts it into the next block here. And let's start off with the 33 put. Move 3 strikes up. So there's the 33 put. And I'm going to tell the system I'm going to sell currently my 30 strike put, Kurt, and I'm going to buy the 33 strike put. Now remember, our risk was 5.8%.
Right.
So if I roll to this strike now, we're going to cut that by more than half. I can drop the risk down to 2.2%. I'm adding $1.90, Kurt, right? I'm going to sell to close my existing put at $1.90, buy to open the new put at $3.80. So I'm putting in $1.90 into the ATM machine to get $3.30 back. $3 back, a $3 higher payout, I'm sorry. So that's essentially, to me, a gain of 110. That's what we reduced our risk by, was 110. So now there's a 2.2% risk on the position and an infinite upside. Okay? So that's a 110 difference in risk. I want to show this. This is my comparison real quick. 110 difference in risk and infinite upside and a risk of only 2.2%. Now, let's go back up. Here's our married put again. And someone might say, well, I don't want to put in money. Why don't you just sell a February call at the 31 strike? Okay. Well, we'll do that again. February 31 call, only 60 cents. I'm only reducing the risk by 60 cents, where the other way I would have reduced it by $1.10. Okay? So, in this scenario,
cap your upside.
We're going to cap the upside to a tune of 4.3%. Not bad for, if the stock's trading right at that price at February expiration. We've only lowered our risk down 4%. Now, what's the X factor here, Kurt? Someone wants to collect premium, calls me on the phone, says, I was thinking about this income method number 1. I see their position, we look at this, and then I say, okay, well, you could do better with this income method number 4, in my opinion, by lowering the risk more. And the customer says, well, I really want to receive income here. I know I'm capping my gain. The stock's almost at 31, but that's pretty good. What's the X factor, Kurt?
Well,
by going
is that there's 11 different.
Right.
There's
well,
11 different income methods. I hope that's what you mean. But
no,
yeah.
Kind of. But this is the reason why I wanted to show this comparison. Is yes, you're capping your gain to best case scenario 4.3%. Let's not forget that. As the stock moves up, the put's going to decline more, so you're giving more back. Let me go to stock research real quick. I'm sorry, that changed off.
Oh, is it going to pay us a dividend?
Well, it does pay a dividend. Sorry, folks. Let me get this maximized here. But we're going to sell a February call, and look what happens on 1/25/2013.
Oh, I see. I should have caught that, yeah.
So I was trying to tease you, but you didn't know. But that's the trade-off. A lot of investors, when they do the married put, say, oh, I just want to do the income method number 1. I want to do the income method number 1. And I'll say, maybe a 4 or 3 looks better if you have earnings coming up before the expiration. So I don't want that upside capped, but I'll be more than happy to reduce my risk by 50% of what I started off with, still leave the upside open by using an income method number 4. That's just what I wanted to show.
I've used this. I've used income method 3 or 4 to bulletproof a stock just before earnings, and that's a wonderful feeling going into the earnings announcement when it's heads you win, tails you can't lose, and that's certainly It looks like with this particular stock, WY, doesn't look like right now you could do that, but you could certainly reduce it down to 2.2%.
That's right. Let me go back to that one. Yeah, I opened up too many windows here. Yeah, the other income method, the income method number 4, would reduce it to 2.2% there.
Okay.
And then here's a quick question in case you missed it. During the presentation, a CW again asked, I understand the value of having an infinite upside, but as the stock goes up, you're losing money on the long put. What about that? You're never losing more on the put than you're gaining on the stock. It's a trade-off, right? You still have a positive delta. And because of the time value of the put, because the put's not decaying one-to-one, that allows us to manipulate this using the different income methods. I mean, that's what the blueprint is all about. The foundations of radioactive trading CD, the 3 core principles to this. We're okay with the put declining in price. I'd rather have 2 securities that I'm still gaining a positive delta on, even though one's declining as the other rises, to make sure that when I'm wrong, I'm not losing more than 4 or 5%.
Right. Very cool. Mike, I'm going to yank the screen back.
Go ahead.
And let's see here. Show my screen. Okay, good. I'm going to go over to the RadioActive Trading site, okay, and the offer on the Home Study Kit right now, there's a special offer going on right now. Now, first off, the Home Study Kit is the blueprint. Oh, I should show the results to our poll here real fast. I said, what is your single biggest objection to getting the RadioActive Trading Home Study Kit right now? 56% said no objection. Let's hear the offer. 11% said $600 is a lot of money. All right. And nobody says that they don't believe the guarantee, and that's good because, we've been around 10 years, and I think somebody would have put us in jail by now if we were honoring the guarantee. But seriously, here we are on the Home Study Kit. Is that what I'm showing, Mike?
Yes, sir. Yes, sir.
Oh, okay. It's $5.99 for the Home Study Kit. It includes the blueprint, right? Includes the blueprint. The blueprint itself is about $350. And when I had asked about a reasonable price, when I said, what would you expect to pay, nobody said, hey, I wouldn't pay a cent. 50% said, no, $350. 10% at least $1,000, and 40% said, I've spent over $3,000 for a less complete solution, which is true. If you've gone to one of these weekend cover call seminars, you've gotten a less complete solution. Well, it's $350 for the blueprint, $339 for the blueprint itself, and $11 for shipping. We don't do it digitally anymore. I stopped doing that about 6 years ago when we had several counts of international plagiarism. Okay, so we're just making it harder on the bad guys. Okay, plus it's kind of nice to have something physical in your hand. So the blueprint is $350. The Home Study Kit includes everything the blueprint does, but also the RadioActive Trading CD Mastery Kit. Now, the Mastery Kit is all these CDs that also do a video presentation of, a multimedia presentation, video and sound, of all the principles and all the techniques and the management techniques. Okay, so we've got 11 income methods. We've got a number of management techniques and a lot of parameters that you would want to follow. And it's all made simple. It's all made understandable and easy. The blueprint is there for ready reference. If you can't remember where you saw something on a disk, it's really easy to go to the table of contents and just, bam, have it on the page, and that'll remind you of what you saw. But the Home Study Kit, the special offers that are going with it, I already sent you out the link to Power Options for a free trial, but you get another month free with that, okay, with Power Options. You get a coupon for $59 off Fusion if you want to look over Mike's shoulder and see what kind of trades he's doing radioactively, or Ernie. That's normally at $69 a month. You get a coupon for $59 off if you want to do that. You get the a consultation with Mike to help you put together your particular trading plan that fits your situation. Okay, and you also get a consultation with me. that'll help you with, what kinds of income methods are going to work with your goals. What is going to fit you the most? Okay, And the value of all those bonuses is actually more than the $600. So there's that. If you pick up the home study kit today, you will have a guarantee. Okay. Remember when we Mike?
Yeah, you get the guarantee.
When you are in a stock and put option, and the put option strike price is higher than what your cost basis is for the stock and the put, then you're bulletproof. Well, that means you can't lose, but you have every opportunity to win. It's the same thing with the home study kit. If you pick up the home study kit and you don't like it, send it back. You get every cent back. Pretty cool. Okay, there's the offer, and Mike, we're past
way past,
time,
yeah. So
yeah, we got a little.